Hi, Assalamualaikum everyone. Miss Salina here from your ITM Melaka. Okay, let's discuss consolidated statement of cash flow, referring to previous semester exam question. Okay, so let's take a look at the question here. Okay, so I did mention before, please always refer to the requirement of the question first. Okay, here we have a requirement to compute goodwill on the acquisition of Alam Surya, and then B, prepare consolidated statement of cash flow. First thing you must identify is the method. So here clearly stated it is indirect method. Okay, then after that, second step is for you to identify cash and cash equivalent. Where can you find this item? From soft P here under current asset and current liability. So cash and cash equivalent in this question is bank overdraft only. In some other question, cash equivalent, cash can consist of bank balances under current asset, as well as short-term investment under current asset, together with bank overdraft like in this question. So what happened? In this question, you are comparing beginning and ending. So always look at the date. Okay, so accounting period in the first column here is 2018, then 2017. But remember, when you compare, you must always compare beginning here 1.1 million bank overdraft, ending is 2 million. So you can see that there is a decrease, a reduction in cash of 900,000, the difference. Okay, so let's continue to discuss the answer. Okay, I have the answer already here. I will show to you. Okay, so first is to determine goodwill. Remember the formula is CT, consideration transferred, plus NCI minus fair value of net asset of subsidiary. So in the question just now, fair value of net asset of subsidiary is given in terms of, here we have assets and liabilities in additional information number 1. So we have PPE, trade receivables, inventory, bank. Okay, these are assets. And then we have debentures, trade payables, and tax payable as liability. Make sure you never add this liability with asset. So you add together all the asset, you deduct with liability. So that will be the fair value of net asset of subsidiary on the date of acquisition. So as you can see here, if it is because the NCI is measured at proportionate, so remember you have to calculate fair value of net asset of subsidiary first. So here you get 3 million. NCI is 20% times 3 million is 600,000. So goodwill will be 1 million here in this question. Okay, let's take a look at operating activities. Okay, what do we have? So in these operating activities, we will always start with net profit before tax. I did mention that you must remember this is before tax. Okay, so once you take this net profit before tax, remember when we discuss preparing financial statement, okay, consolidated SOPL is actually being prepared under accrual basis. Okay, however, statement of cash flow, consolidated statement of cash flow is being prepared as under cash basis. Okay, so what you will do here, so when you take this net profit before tax from SOPL, okay, you take from SOPL, consolidated SOPL, you must do certain adjustment. Okay, because in SOPL, when we prepare SOPL, in order to calculate this net profit, you already deduct with the item which is considered as non-cash. So item that is considered as non-cash in this answer, you can see here, we have impairment, depreciation, or amortization if it is intangible, and then loss on disposal. So this is considered as non-cash item. Okay, non-cash item. Sorry. Okay, non-cash item. Okay, non-cash item. However, we also have item which is considered as cash. considered as cash. Okay, this is considered as cash. Cash. This is non-cash. So what happened for this non-cash item? You will add back. Okay, so depreciation, loss, and then impairment will be added back to this net profit before tax when you do adjustment. For this cash item, if it is an income, okay, you will deduct. Like here we have share of profit. It's an income. So you deduct because you are working backward. I'm using this word, working backward. Okay, because you are taking net profit before tax. This item is the last item in your SOPL. So you work backward, meaning you add back expenses and then you deduct with income. Okay, because if it is non-cash item, very clear that you will add back. Okay, but there are also cash item which you adjust because of other reason. Okay, like this here we have finance cost. Why do we need to add back finance cost? Even though this finance cost, is one of cash item, because this finance cost actually related with this one item down here that we call as interest paid. Here, okay, interest paid. Okay, finance cost or interest expenses. This will be interest that will be paid by the company. So interest paid and finance cost related with each other. Okay, in this question is quite straightforward for this part because finance cost is 300,000. The amount of interest paid as well is 300,000. So for this adjustment, what you need to do, you have to add back up here because you wanted to deduct down here. Okay, because finance costs basically have been deducted when you calculate this net profit before tax. So that will be adjustment for finance costs. And how about share of profit of associate? Okay, this will be because of we have dividend received from associate down here as the adjustment. That's why you will deduct this associate. Back to this interest paid. As I mentioned, there will be either one of or out of two situation. Interest paid will be the same like finance cost. Okay, the similar amount like finance cost, like in this question. However, there are another set of question where interest paid is not the same with finance cost or interest expenses. Why? Because when you refer to SOFP, okay, you have to look at consolidated SOFP. There are items that we call as accrued interest. Okay, so when we have accrued interest or interest payable, in this situation, what happened? The amount of finance cost here will not be the same with the amount of interest paid. Okay, because at the end of the year, okay, the company still have certain amount which is not yet paid, certain amount of interest which is not yet paid. You can refer to consolidated SOFP under current liability. Okay, this is operating activities. After that, you need to calculate after the adjustment just now. Here is the second part where you have to calculate increase or decrease in working capital. So the most important part is inventories, trade receivable, and trade payables. What you need to do, you have to compare beginning and ending. However, because of this is consolidated statement of cash flow, okay, what you need to do, you have to include inventory, trade receivables, and trade payables of subsidiary. This is the part where it is different with basic one company statement of cash flow. You have to make sure you take into account BD, inventory, then CD of inventory, and then what happened during the year when we have subsidiary. So you have to take into account these three different area when you want to calculate increase or decrease in this working capital. Okay. So this is the second part of your operating. And finally, we have tax paid and interest paid. So I have discussed this interest paid before. Then let's move to tax paid. For this tax paid, Normally, what you need to do, you have to prepare this tax payable account. Very simple. So this is from your SOFP beginning, and then we also have from SOFP at the end, beginning and ending balance. You must identify if it appear as current liability. So tax payable beginning will be in the credit side. Automatically ending will be in the debit side. However, if let's say you come across this term tax recoverable, okay, tax recoverable, so you may have beginning in the debit side because this tax recoverable is current asset. Okay, tax payable is current liability. Okay, so if it is tax recoverable, you may find that this beginning balance in the debit side, because it is asset, automatically we have ending balance in the credit side. Okay, so what happened after that? We have this amount that you will take from consolidated subloci. Okay, this is amount 2 million from consolidated subloci, and this is the additional amount that you will take from the acquisition of subsidiary. This is the new part when we discuss consolidated statement of cash flow. So what you need to do, you will close this account and then you find this balancing figure. So this is balancing figure. I would like to advise you, when you prepare your answer, take a very short time after you have prepared this working. Okay, I suggest that you do highlight, or you kind of like do you round this figure, because this will be the figure that you will carry to consolidated statement of cash flow. This is because based on my experience, I can see that some of the students, they tend to do mistake where the student take different figure to be transferred to consolidated statement of cash flow. Instead of taking this 1.2, some student, they carelessly take 1.8. So as a precautionary measure, what you can do, you can highlight or you can circle this amount to show that this will be the amount that you will transfer in consolidated statement of cash flow. You can do the same with the rest. Like here we have, this is the amount that you will transfer to consolidated statement of cash flow. Okay, I hope you understand this part. This is cash flow from operating activities. This is preparing statement of cash flow, consolidated statement of cash flow using indirect method. Okay, see you all in the next video. Bye.